Welcome to Smokin Bulls, the podcast about business, money, and lifestyle. I'm Tyler.
I'm Dave.
And today we have the pleasure of being joined by James Cowan, a lead portfolio manager at Northleaf Investments. I also partnered with Mackenzie Financial. Today, Dave and I will be chatting with James. We want to touch on a brief disclaimer at the start of our podcast and off the top. The podcast is for information purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. So thanks very much for watching, everybody. Thanks very much for being here, James. I'm going to turn it over to you a little bit so you can introduce yourself, a little bit about who Northleaf is and maybe your affiliation with Mackenzie, and we'll get to learn more about the products that you guys manage.
Great, and thank you very much. Very pleased to be here in Edmonton. I should note, although I am from Toronto and I have both Mitch Marner and Austin Matthews jerseys, and Matthew's been playing hurt. I just want to make that clear.
That's what we heard, yeah.
However, I do have some history in Edmonton. I probably am the only person in the room who helped build the West Edmonton Mall. In fact, one of their access ramps I helped build back in 1981 as a student.
So there you go.
Good long history in Edmonton. So very pleased to be back here.
Is that ramp still standing? It's still functioning?
I would certainly hope so. I'd go and check it out.
Put a lot of work in minus 20 on that.
It was hard yards, but very pleased to be here. So I'm a vice chair of the global private markets team at Northleaf Capital. Northleaf Capital is one of those great Canadian success stories that a lot of people, even in the investment world, don't know, because to date, since the 60s, when we were part of TD Bank, and known as TD Capital, we've had an institutional focus. So we've been in operations for decades. We are the preeminent mid-market private equity, private credit, private infrastructure manager in Canada, and second only overall to Brookfield and probably Onyx. But we've had that institutional bent. So it just didn't make it into the press, didn't make it into private wealth managers' heads. And we were fine with that because one of the things, when you're in private markets, you don't necessarily want to be in the press. Where we fit in this sort of a bit of an overview of where we fit in people's portfolio is in that sort of boring side. It's parked long-term investing where you just want to turn it year over year. And that's where we'd like to be. So Northleaf has, as I said, been in private equity since it started working within TD Bank. They were spun out after the global financial crisis. They then hired in a whole lick of people on the infrastructure side from Macquarie Group, which was and still is the largest infrastructure manager in the world. And I'm one of those 13 or 14 that have ended up at Northleaf over the years. And similarly with private credit, our third asset class, that was not only has been around for 8-9 years within Northleaf, but the people who are hired to build out that practice had worked together for 10, 15, 20 years before that. So a very long track record, which I think is essential to private markets investing. It's so very different than listed, where you can go up and you can pull up on your screen all sorts of metrics. When you're looking at the private markets, it's very different. And that's why individual investors have had such a hard time investing. They just haven't been able to get access. So we're very pleased several years ago to partner with Mackenzie. And what our job is, we picked what we thought was our best private equity strategy, our best private credit strategy, and our best infrastructure strategy. We do lots, but we picked one in each asset class, partnered up with Mackenzie to bring it to the retail market. And why we think that's very advantageous is you have the private asset manager, me and 250, 260 other people doing what we do best, and Mackenzie doing what they do best. So they've wrapped it very nicely. There's a liquidity sleeve to ensure that there's good liquidity available for investors. There's the tax reporting. There's all the servicing for brokers such as yourself and others, which most private managers can't do and frankly don't know how to do it. And so we thought that was a really good partnership to be able to bring these three asset classes in. If you look at CPPIB and to blow another Canadian, the trumpet, another Canadian success story, CPPIB is the largest private equity investor in the world. They're on track to be amongst the largest private credit and private infrastructure investors in the world. They do not do what we do. They are big ticket. They're like Goldman Sachs, KKR, Ontario Teachers. They do all the big transactions. great, good place in your portfolio for that. But what Northleaf does is we do the mid-market. So we're sort of a step down. But CPPIB has almost 60% of their assets in private markets.
Yeah, this
almost
is something we've talked to. We've watched it. Yeah, we run a smaller pension plan for a teachers group, and we mimicked kind of that structure, and it's hard to do. I know we're jumping kind of on a bit of your intro, but the fact that we were able to access some of these types of assets and put into a smaller pension plan is significant, because most of them don't have any of the private infrastructure, credit, private equity. And so when we went and looked it up just to see how CPP's breakdown was, I was surprised. I think it was 13% public equities and maybe 20 something public debt. And holy smokes, I couldn't believe it, that those numbers, which is
and that's amazing. By pension plans, sovereign wealth funds, big foundations all around the world. If you look at the Asian wealth, the incredible wealth in the Arab world, the oil revenues, they are not doing the 60-40 split by any means. And so we really hope we can add to that. And I should note, with our particular strategies at sort of a macro level, when I talked about that mid-market, people sort of say, what's that mid-market? Well, the mid-market it can be anything from $10 million EBITDA to maybe as much as $300 million EBITDA. Typically more in the 40 to 120, 150 million. But these are well-established companies, real revenue, real EBITDA. If you look at the mid-market in the United States, there's a great picture. It's an iceberg, and it has 3% of the iceberg above water and the 97% below. And that's the breakdown in Canada, the United States, for publicly listed companies and private companies. So your typical private wealth retail investor can only access 3% of the market. That 97% is the second largest economy in the world on its own. We invest in the US, Canada, Western Europe, Australia, and New Zealand. So all rule of law, very developed countries. The mid-markets of each of those combined could potentially be almost as large as the entire US economy. So when you think about your investors and try and get them access to good opportunities out there, that's potentially the biggest economy in the world, all rule of law, and say, I'm not going to touch that. And so that's why we think it's really important to sort of, as the saying is, democratize private markets, because why should it only go to, the big sovereign wealth funds, the super wealthy? Why not have everybody be able to access them?
And it's kind of along the lines of why do most Canadians have 80% of their portfolio in Canadian equities or Canadian investments? It's the same iceberg situation. They don't look outside, or they got the home bias. Being able to open up the private markets is substantial to individual investors if they can, get set up with someone who can access that for them.
Yeah, I've always thought that there are three things that brokers, portfolio managers of people's money should do. The first is ensure there's diversification. The second is asset allocation, and I think that's pretty much accepted now as having a very good statistical track record that asset allocation is so important. But what I think is often left out is the manager selection. Because you can have the right asset allocation, and you say, we're going to put 5% into office. And someone could say, well, you've got 5% real estate, that's fantastic. But if you had all 5% office in mid-sized U.S. cities, right now you'd be looking at zero. You would have lost 100% of your equity. Yeah. So it really is picking that manager. And what we've always thought about is its manager. There are four things, the four T's, although one starts with an I. Investment thesis, but there's the T. So thesis, track record, team, and trust. Now, trust largely comes from the first three in meeting people in person and all of that, but it also comes from things like alignment. So at Northleaf, we have coming up on a couple $100 million US of staff money invested in our funds. The three strategies that we've teamed up with Mackenzie are three of the most popular funds at Northleaf for people putting their money in. And our future remuneration is tied to how do those funds perform. So as investors want to say, I don't mind if my broker or my advisor gets rich while I get rich. But if I lose a penny, I want her to lose money, and that's how our arrangement works, and that builds up that trust. And so I think that's one of the things that sets us apart. Are those that are the way we've been able to put those 4 pillars together, as well as that mid-market strategy. Typically, and I don't have all the details in front of me, but you're looking at in mid-market, historically, the wide market, and we like our numbers so that we have performed the wide market, but the wide market is that you get better returns in the mid-market than you do at the very big companies. And if you think about that, that does kind of make sense. If you are buying BC Hydro, that would probably be a great company to own. But boy, you want to change the staff culture, the safety, negotiate new it's going to take decades and tens of billions of dollars of investment. If, on the other hand, you have a battery plant and you've got a wind farm and you're able to expand that wind farm, put in good new battery storage, negotiate take-or-pay contract, there are a lot of levers that you can touch that will immediately deliver value. And those are the projects that we're looking for. That's sort of a segue into a plug for our infrastructure.
I was going to say that sounded a bit like infrastructure. So,
well, that's why we got interested, is they are truly diversifying your traditional 60-40, the financial markets you see reported on the news for 30 seconds every night while you're eating your dinner, private equity, private infrastructure, private debt. These are things that attracted Dave and I to that marketplace, because it doesn't function on the day-to-day swings and the volatility that you experience in traditional financial markets and that retail exposure. So that got us interested in those pieces. And that's back in 10 years ago almost now, Dave, when we started tinkering with
and from an individual's portfolio. I mean, for us, the fact that you can diversify with that, I mean, you're giving up some liquidity, but you're not using 90% of their money in this. The 70% would be, I guess, public markets, if you want to call it. We would use a 30% alt sleeve. And if we look at our track record since 2016 of doing this, we basically achieved the benchmark of the equity markets that we use with like nowhere near the volatility. I think we capture 90% on the upside and 60% on the downside. So that's mostly due to the alts. If you look at our total alt average return over the last, whatever that is, 8 years and change, it's higher than the total average portfolio return. So it's what's been supporting bad fixed income markets, and obviously, last year in equities has been pretty good, but there was some pretty sideways years there during the COVID years. And if you didn't own specific, 7-8 names, you didn't make a lot of money back then. So it's been the supporting part of our portfolios for a long time. And, we explain to our clients the liquidity part, but when you go through and have options like Northleaf and Mackenzie, the liquidity is way better than it would be if you were parking your money in a 10-year deal for private equity. So this is the beauty of this partnership and a lot of this private investments that are coming forth that we're allowed to use as portfolio managers, which is great for our clients.
Well, I think so. And what we try and do, diversification again being so important, there have been a couple of hiccups in the Canadian market on the private credit side. A couple of companies run into difficulties. And what our strategy is senior secured floating rate. So you're at the top of the capital stack. You've typically got 60% or more equity in front of your debt. All the companies have positive EBITDA and real revenues, but it's about 82 loans right now. And the largest loan is maybe 2.7% of the book. Most of them are around 1%. So you have that really large diversification such that if one or two do go bad, and we're in for some choppy times in Canada, perhaps more so than pretty much any other developed country going right now. Even if some do, most of the book is in the U.S. There's only a little bit in Canada. There's a good exposure in Western Europe and Australia. So you've got really good diversification that way. But you also have, as I said, 82 loans, and that's going to increase. And as an investor in the Mackenzie Northleaf Private Credit Fund, you're going into a fund that is $2.5 billion US, has tremendous liquidity, and has been around for a long time, managed by people who have been around for a long time. And I think you're not going to see the issues that have happened with some smaller shops where they only have a little bit of capital and they're not able to get the diversification to ride through tough times. And I think that type of strategy is also important. In private equity, we use a secondary strategy, which I think is also the most popular strategy that we at Northleaf invest our own money in. So we like that one. And what we're essentially doing is providing liquidity to the multi-trillion-dollar private equity market. And that's a very important function. Many private equity investors change strategy. It can be the denominator effect because different asset classes, typically private equity, have done well, so they need to sell. They have a ladder. So just like a bond ladder, a lot of institutions have a fund ladder. So they go every 2 years when you have a new fund, they give you some money. But if they're not getting money back, they're short of capital. Every time there's a new CIO wants to change up. There's so many different reasons why they change strategy. And then you get big institutions, CPPIB, Goldman Sachs, every year they're selling off secondaries. So we provide that liquidity that often allows us to buy good funds, because we target only specific funds, at a discount. And those discounts can be up to 18, 19% from their fair market value. And you combine that, for example, over the last year, any of our divestitures, 84% have been at or above their book value that we have them on the books for, and about a third more than 10% above the book value. Mm-hmm. And you contrast that where you do read in about private equity is that there's a liquidity crisis, that valuations are overrated. Where we're at and where we're able to do just our little space, we're able to buck those trends. And across all three strategies in the past 12 months, ending March 31st, we looked at over 2,000 investment opportunities, and we did about 4.5%. And I think that selectivity, so long as we can maintain that, and all of those 2,000, there are lots more I get emails every week about stuff that we looked at, they all fell within our strategy. So arguably, we could have done 2,100 deals in the last 12 months, but we chose not to. And I think that's one of the best reasons why I think prospective investors such as yourselves and your clients should maybe look at a Northleaf and say, all right, that's a metric I like. When you're doing 10 or 15% of the transactions, well, I'm probably not going to be giving you any more money.
Yeah. And when we build a portfolio, it's interesting because if you think back, I don't know, if we were building the 60-40 portfolio 9-10 years ago, you would look for correlations between your equity. So why am I owning 3 funds when they're pretty much 95% correlated? Well, when you look at things like private debt, private equity, you could have 2 private equity funds and they're not correlated at all. Now, if they're both secondaries, maybe there would be some overlap there. But generally speaking, you're diversifying between a manager at that point because it's a completely different portfolio. So it's good for us in a sense that we're not worried as much about a correlation from having multiple managers managing the same type of thing. It's just keeps it diversified, keeps it competitive. Where you might be private equity in the secondaries, we might have small mid private equity, buying direct, and they're always going to have, for liquidity purposes, a little bit of a sleeve that's a secondary type thing. But it's just good for us and good for the clients to have all of these diversifying factors. I think most people just aren't aware that this private world exists, and because it all just gets lumped in alternatives, I guess, because you got your public equities, your public debt, or public fixed income, and you have these alternatives. Well, and we say to our clients, like 90% of what's in that space is you wouldn't even bring forward. I mean, there's just so much stuff in there that is just wrong, I guess, in a way, but that you have to hive it down to top performing companies that have a long-term track record that provide the liquidity for our clients, because that's probably a big thing. They're not corporations and entities and governments that can run on forever and ever. They have goals, and we have to have that liquidity. So it's great to have you here to talk about these things.
So when I was with Macquarie for almost 23 years, when I left there, coming back to Toronto, looked around, and I did much. I already knew the asset class because I wanted to do private markets, but I did my manager search, and that led me to Northleaf. I was very pleased, and so thankfully they thought the same thing. So we were able to marry up there. But the strategy, you're right, the layering in of different private managers, I think is really important. A lot of people we're finding on the private wealth, and even at the institutional, if you go back 20 or 30 years, they would start off in, Canadians typically start off in real estate, not more volatile than necessary, but everybody in Canada seemed to go, all the institutions went real estate. In the US, they all went private equity, which is very, it ties in with our two different countries.
Our mental mandates.
We're very, good government, and they're, the Wild West.
Yeah.
But over time, you've seen the US, they've slipped down, if you that risk curve, if you want to call that, to private credit and infrastructure, not so much real estate. And in Canada, real estate's sort of been left behind, and the institutions have moved into private credit, private equity, and infrastructure. And so it's fairly similar now between the US and Canada. It's taken 20, 25 years. And people often ask, well, how much as an individual should I put into this? And so we would typically see people start with one. They're not going to say, well, I'll get a bit of each. So I really like that credit story. It's all interest. I can put in my registered account. That's fantastic. And then they start, well, that's pretty good. I'm going to try some, private equity because it's got great returns, or some infrastructure because, as we call it, the holy trinity of investing: capital preservation, yield, and growth. And they build that up. And I'm not surprised to see people go 5, 5, 5. Some people will do 10%, 10%, 10%. Yeah. And you will find we have somewhere, and Mackenzie can provide that with you, looking back 5 or 10 years on a 60-40 versus bringing in 10% infrastructure, private equity, and real estate. And I think the average return went up 150 basis points, and volatility went down a couple hundred. It was in that neighborhood. Yeah. So material differences, lower risk and a better return. If you're just putting 1% in, you'll get that, but it doesn't really make a difference. So I think people need to be comfortable if they're doing 5, 5, 5 or whatever, that not only do they need to make be comfortable with it to make a substantive investment, but also that they should leave it. Yeah. Don't be trading it in and out. This is where you've picked an asset class and you've picked a manager with a particular strategy, and that's a strategy that's going to play out over 5, 10, 15 years.
Yeah. Yeah, I think you touch on something that we can talk a little bit about, when we were first, years ago, looking at private debt, private equity. One of the things that was brought to us through a manager was just almost the risk profile of asset classes, which everybody has access to, but most people don't get to see when you tie in the private side of things. And what I found interesting was, in the last, and this was 5 years ago, I think, when we went through this, so the previous 10 years, private debt was your lowest risk asset class, then private equity, then government bonds, then corporate bonds. I don't know where infrastructure, because we weren't talking infrastructure at the time, but it was amazing to see that these private pools and private investments were, lower volatility than pretty much a government bond pool or a corporate bond. So, but it has proven itself. I think the only way we ever have is liquidity, and the fact that something that you solved when you pair up with Mackenzie is just kind of some of the issues that have happened in Canada. What rules do they have to follow compared to a normal mutual fund, for example? And I think that's part that maybe worries people. So it's kind of something we have to overcome. That's part of the diversification of different private managers, and not necessarily, as I mentioned before, what's in that alt space. There could be a lot that just isn't right for most people.
So I think that's critical. It gets back to that manager selection and what they can look at managers like ourselves, and there are lots of good managers around. It's not we're the only ones. Is that because we have those institutions, 270 odd institutions, who all do due diligence. I was on a call, an investment committee call yesterday, and it came up about some investor, a major outside of the Americas investor, and they had submitted over 150 questions in their due diligence questionnaire. And it's not uncommon to get 50. You can get a 10-page questions for 10 pages in very small print. But if someone said, it's a bit more than we normally get, and that will take one of our staff at least a week. So that's a full And we have 270 people doing that. Plus, we have consultants. A lot of investors have consultants who do the same thing. They come in every 6 months and year. They do operational audits. So I think that people should rest assured when they see a particular manager that has loads and loads of kind of name brand institutional investors, they should still do their work. They should still read the documents, please. I know they're small print and they're really long, but do read them. But you can sort of say, okay, some really good due diligence has been done on these people already, and you can take some comfort for that.
Yeah, and that's great. I mean, we're getting bombarded now by like 9 million private debts that are available. So you can see that the proliferation is growing and that advisors are looking more to use it. It's nice to see things like infrastructure, equity get a little bit wider too, because it does give us choices. It does allow us to go that pecking order, because there are some that are very one-off and either don't have a lot of institutional investors. They're more of a retail structure. So that's what we have to sort through on our side. And, give Wellington Alta some credit, because they allow us to use quite a bit of these, but they do a lot of work at saying, filtering out a lot of the stuff that's out there that I've mentioned how many different times here. So yeah, it narrows it down quite nicely, and we review them, and, there's some really cool things out there that are available that we just started using some. What's the one? Music royalty. That's kind of fun. That's kind of that's something that big pensions can get into, because it's a bigger market, but same type of thing where you're going to fall in small, medium-sized things.
So we actually have a strategy in music royalties, but we purposely chose that's not the one to take out to mom and pop.
It's very niche. It's very small.
It's niche. And what we want to ensure is that why we've gone with the better returning, lower volatility strategies in each is that should be their first experience. People should not be. We do venture capital. We have some Canadian governments give us some money as well as others to invest. It's a public program. People, it's all on record and everything. But that's something. Once you make your first 25 million, you should start, collecting watches, art, and doing venture capital. When you've got your first 200,000. Can I say that? Please don't do venture capital, because you can, like, oh my stars, some of these funds return insane, but the risk level.
Oh yeah.
For all of our products, you still get in big bold letters, you can lose all your money. It doesn't matter that we've not had any losing of it. But with venture capital, they really mean it.
Yeah. We haven't touched any venture capital. I'm not quite sure.
You need to get your first 25 million.
Yeah. I'm not there. Not there.
We can start buying.
Million, you get the jet.
One gold coin and one bottle of fine whiskey. I think that's all we got going on. One day. Yeah. Nice.
Yeah. Can you comment a little bit about your private debt market? Dave and I are familiar with it. It's a huge market. I think it would surprise people to hear the depth and breadth that exists in private.
It's a good question. There's lots of charts kicking around about how quickly private credit market is growing. So it's got to be over $2 trillion US now. And I always caution people saying, don't invest because it's growing really quickly. You need to find out why is it growing really quickly? Because often if so much money is piling in, maybe it's not the best time to invest. But with private credit, it has, and particularly again in the mid-market where we are, the smaller size, where there are tens and tens of thousands of companies, even several 100,000 companies that we could potentially talk to. It's a sucking time. They are pulling the money in for a variety of reasons. One, it's always hard to get capital when you're a mid-sized company. Like, you're not big enough for the bond market or for an investment banks or big private equity firm. It's always a challenge, and it's costly. You're a bunch of people who have a growing business. You're not financiers. And typically private credit is going to be 5 to 7 year term. So you're doing it every you just don't have that expertise. Total pain. In the U.S., since they rolled back Hamilton's Very Good Banking Act or acts, the U.S. has had a regional banking crisis like every 20 years. Savings loans
sitting on one right now.
Yeah, and it just keeps going on and on and on. And then you have the big banks, and some big banks are having issues, particularly now in Europe. Which is one of the strongest areas of growth in mid-market private credit we're finding. So you also have capital tightening. So you have major institutions, lending institutions, moderate size, small, all of them have a good reason to batten down the hatches and just offer crazy terms because you only want to lend under crazy terms. Otherwise, you're in capital collection. You need the loans to be repaid. So we see that as a huge opportunity, and we see hundreds and hundreds and hundreds of potential opportunities every year. Our particular strategy is built around investing with private equity firm sponsors that we know well. So we track some 900 around the world, pretty good terms with about 250 mid-market private equity sponsors. And why we want to partner up with them. So they're investing equity, they're buying a company, and we're going to lend the debt in. Is we know we like their investment thesis, we like the investment professionals, and we can see that this is Fund 5 buying this company, and their previous 4 funds, were they all first and second quartile across a bunch of different metrics, or are they third and fourth, or do they bounce 1 and 3? So you can separate the wheat from the chaff there, and so you have really good teams. Track record, investment thesis, they're buying companies. So that's the place where we want to look at and invest. And even still, we pass on so many of them. So I think it's that very selective strategy within an overall market where it really is pulling money, and the regional banks and the big banks are happy to pull back. Canada's a little bit different. It's hard to get a handle on, because I think the big banks do not like anyone coming in and playing on their turf. They also realize that they have to let people play a little bit on their turf, otherwise they're going to get in trouble with the feds and competition. So that sort of balancing act. Yeah. So we do, and we actively look for business in Canada very much. But it is a bit of a hard market in private equity, private credit, and infrastructure. It's a very expensive market because we have so much capital. Unlike the US, where they have totally unfunded government liabilities, or where they do have some funding. You read about, I think it's Illinois or Chicago, the pension plan's 18% funded. In Canada, our pension plans are all well funded, and the government pension plans, even CPPIB, or CPP, is well funded by CPPIB. So those trillions of dollars of capital are just too much for the Canadian economy. Right. So that's why they invest so much out, and it makes it expensive for anyone else to come in. Yeah. We do have some good investments, and we have a part of the Ring Road in Calgary. We have a hospital in British Columbia. We have Toll Road south of Montreal. No offense to people in Montreal, but the line always gets the jokes. The best thing about it is you don't have to go to Montreal. That usually plays well around NHL playoffs, which I'm kind of sad we haven't really talked about. Yes. I did try and bring it up at the beginning. Yes. We want to talk about products.
So talk about all the good stuff. Well, on that private debt side too, I guess for us to see so many come on, it is something that we have to be wary of, because, as you say, you're being very selective. I think what happens to the other 1,800 deals that you don't do? So they're going somewhere. Somebody's going to fund them eventually, or maybe not. But that, the pecking order of what's good credit down to what's not great credit. I mean, if there's all the capital that is coming in through all the different sources, it's trying to find a home. It's going to go somewhere. And so we want to be really careful on how we pick our managers for our clients, because not every private debt fund is going to be the same credit quality, the same liquidity. So these are things that, when you're saying, well, where's all this money coming from? Well, people are fleeing low yield. Well, they were up until, say, a year ago, low yield. And, right now they'd rather sit in a savings account at 5%. So, but that money comes into these funds and they all want the returns that have happened in the past. But when you have too much capital, maybe the credit quality starts to fade a bit as managers try and get out the door.
Certainly over the last year and a half, the amount of leverage we've got, it's probably dropped by a full turn. Okay. Covenants have gotten a little bit tighter. Spreads have pushed a bit. So there have absolutely been shifts over the last 18 months or so. A number of credit managers, again, getting back to that thesis, may not only do mid-market private credit. They may do as they call it, upper mid-market, large cap, large scale, there are all sorts of different names. They may have high yield debt. And remember, high yield debt is not private credit. High yield debt is, it could be private credit, it could be public. It's really risky. Yeah. So if you have that in your private credit fund, it's a different risk profile. Yeah. There are a number of private credit, they call it private credit, they should be more private debt funds, where they'll have corporate bonds and they may have listed bonds. So you really have to look through, and that's why I said you have to read at least some of the funds.
They might have equities in some of them too, which
you could.
happened in the past, which is...
I have through a broker, they bring certain types of equities into their fixed income and certain type of fixed income into their equities, because those securities, even though they're called fixed income, really trade like an equity. So you really have to look at that. Yep. It's not like our grandmothers, 60-40. And although I should say, when my parents, my dad died a couple of years ago, but when they were in their late 80s, I took over, managed their little book. It was 100% equities. Oh, wow. 100%, late 80s. And they've gone through this huge bull run. Yeah. They made they didn't, they never expected to have that sort of money because they had risked it all. Now, if we'd had a crash,
oh boy, yeah.
So you can get lucky, but that's not financial.
That's not planning.
That's love life. Not financial.
That's good point.
So we're talking there a little bit about risk, and one of the things that have been driving our portfolios over the past year and a bit has been interest rates and how they've fluctuated and how that affects equity markets and your traditional bond markets, of course. On the private side of things, maybe you can speak to how interest rates affect your products, because we've found safety and consistency on that side of things. Maybe you can address that a little bit.
Absolutely. So for infrastructure, typically high interest rates are your friend for value because it drives high inflation. It's usually high inflation comes before interest rates. With infrastructure, because you spend a whole lot of money building your bridge or your aqueduct or your airport, and then you keep it in good repair for the next 50, 75 years, inflation is very much your friend. A mature toll road, 30 years into its life, that's good operation. If you increase your tolls by 10%, it could be as high as 90%. Even more of that drops to your bottom line. Mm-hmm. So it's pretty simple equation. With private credit, we specifically chose floating rate. So in 2022, the strategy, the institutional fund had about a 3% positive return. In 2023, it was about just under 6% positive return, when fixed income books were getting killed right across the country, the U.S. Mm-hmm. So that's the strategy specifically designed with that. And as I said, over the last year or two, we've tightened things down. So it's lower loan to value, lower returns, tighter covenants and spread. So that's worked very well. I think private equity is probably the area that people should look the most at. Again, infrastructure, if you have a toll road, you might get 30 per year fixed debt. So you want to take all interest out of that, or interest risk. With private equity, that's something that people would be more concerned about. And so that's where you need to have a manager with a thesis that if they are really tight on their underwriting, then they should have pretty limited exposure. Now, interestingly, this turn of inflation to date, most producers and retail and manufacturers appear to have had pretty good success passing price increases along. My view is that is coming to an end. And so if we have, if inflation punts back up to 4 or 5%, including wage inflation, importantly, over the next several years, I think you're going to see a much bigger impact than the last several years. Because what we have seen both on private equity and private credit, where we track most closely, is that margins have stayed pretty healthy. And not what I would have expected. Mm-hmm. If you look back to the 70s, inflation, remember, lasted for a fair amount of time. And they were not able to pass that on to the end purchaser. And so that led to some real issues for the manufacturers. What we've seen to date is price increases, some cost cutting. but not a wave by any means. In private credit, again, I'm quoting these numbers by on top of my head, a broad industry standard default rate. I think it got it under 1%, maybe to 0.9. The long-term average is 1.6. And for the last year or so, it's been at 1.9. So not the 3, 4, 5% that you've seen in previous crises. Mm-hmm. That could still happen. For sure. You need to be vigilant. And I don't mean to downplay the risks out there, but 1.9 versus the long-term average 1.6, we're still okay. Now, as I think we were talking about, I think Canada has more headwinds coming than perhaps some of our G7 compatriot. And I think that's something that we'll need to be very careful here. But that's sort of through our underwriting that we hope to take that into account.
Mm-hmm. Good. Yeah, I'm going to jump back. This is more a policy discussion, I guess, at this point. Because it came up because you made the comment about how Canada's very capitalized because of our pensions, things of that nature, where we have a lot of investment money and it has to go other places due to the size of Canada to be invested. We have a government that's kind of suggesting that maybe we should restrict. It almost feels like when I first got in the business that you can only have foreign content limit of your RSPs of 20%, and then we fiddled with funds to make them all RSP eligible. Yes. So we dropped that. It's not possible. But what would that do if they start to pinch on those type of things? What kind of impact is that?
I think that it will have a big impact. So I remember when it was 10%, and everybody who has an RSP or any registered account or any pension plan would be immeasurably less wealthy. With all our troubles, we are an incredibly wealthy country. Mm-hmm. Make no mistake. A poor person in Canada, not to make light of it, could be a rich person in many countries. It's sad to think of it that way, but that's what. So we live in incredible wealth. A good chunk of that has come from the fact that they took away those restrictions and we could invest. As reports were out today, and I think international inflows were up 6%, but money flowing out, investing was up like 10%. So we are, because we have such a small part of the overall economy and we produce this wealth, we are investing it in other countries. That's true. We are generating wealth in other countries, but that all flows back. The capital gains, dividends, and interest is a great big funnel of cash coming in to help our country be so wealthy. So I'm a very firm believer that you need to do that. And I think if I can, we haven't talked about ESG, but I'd like to bring that in. There are a lot of people down south, and even some in Canada, saying, "Well, ESG, that's a bad thing." And again, it's this essence of government coming in to sort of say, "We're going to tell investment professionals how to do their job on a policy basis, not on what's good for the investment, but on a public policy basis." And ESG is simply good investing. If you don't check out the environmental aspects of what you're doing, you're going to face massive liability. You can have people go to jail. If you have a really crummy, this is particularly important in infrastructure, if you have a really poor safety record, well, you're going to get in trouble. You could also have people go to jail, but when you go to sell that company, you're not going to get nearly as a good check for it. So all of that ESG, that's been driven by people with good investment practices. So that's a long way of coming back to saying the same government who wants to say, well, you can or can't do that, also wants to make rules about can you invest 10 or 15%. And it's going to have the same negative impact. What governments need to do, and I think they need in Canada to do a better job of it, is to hold investment managers, anyone with a fiduciary duty, to a much higher standard, that they have to do what is best for the people they're serving. And if they do that, then they're going to do good things. Because if they do bad things, that's going to lead to bad outcomes. And so I'm pretty passionate about it because I've seen what it's done for the country by allowing people to build that wealth. That's what pays for all our programs and makes it such a great country.
Yeah.
I get a plug-in for the great country.
Yeah.
If you didn't pick up, I also have,
patriotic.
Besides my Leaf jerseys, I also have some Canada jerseys.
I thought you were going to say some Oilers jerseys, but okay.
We have some Oilers stuff. We do have some Oilers stuff, without a doubt, but that goes back to Gretzky.
That's
we were all
Ontario's. We were all
everybody was,
yeah. What do you got?
Nothing out of the ordinary. Just kind of curious, and you've kind of touched on it, and it all comes down to, I think, the due diligence that you're suggesting or referencing that your company does. But what would make a bad investment in infrastructure, for example? So maybe you've got a company in there that didn't have a good safety record, and you're touching on how that's going to limit their profitability and the ability to sell them. So when you are transacting within the portfolio, are you actually selling that infrastructure position to another private equity or private infrastructure portfolio manager? Is that how you transact on this, or who takes things off your hands, I guess?
Well, it's interesting. I'll deal with that first and then get back to your first question.
Yeah.
It's typically big infrastructure managers or corporates who have they're a tank farm business, or you'll have the sovereign wealth funds and big pension plans who are very active and direct investors. So there's quite a pool. When you go to look at anything, of course, you always have to keep in mind, how are we going to sell this? And what has happened with some of the big infrastructure managers is they bought big businesses, they've owned them for 10 or 12 years, so they're bigger, and they don't really have anyone to sell them to. And so they're forced, maybe we're going to have to do an IPO. Well, the IPO market has been pretty poor of late, and they don't really understand, the markets don't really understand infrastructure. So that's an issue. That's something we don't face. We have lots of exits, which is very good. The key thing to think about infrastructure is, if you buy an airport and it's in the wrong place, it is in the wrong place. You can't say, well, it was an airport, now we're going to make widgets. Oh, fantastic. Right. Mirabel, let's pick on Mirabel. By all means, I've not been to it. I've seen it in some movies, and it looks beautiful, because that was what they were using it for a while. And then they used it for cargo, and then even the cargo gave that up. Beautiful airport, gold plate, typical government, way overbuilt, cost multiples of what it should have been. It's in the wrong place, and people didn't want to go. And so that's the real risk. You have to be absolutely certain about the thesis, because if you're buying, I referenced earlier, a wind farm that has battery storage, so that you can play it, if you have really windy day, but at night, that's when everyone needs the power. We've got the battery. You can. Mm-hmm. However, if your wind studies were totally wrong, or you goofed up and there isn't really much wind, you can have the best batteries in the world, the best offtake contract, but you don't have that energy. So you really have to do your due diligence. And that's why, to us, good government, societal, environmental, it's just part of, dozens of things that we look at when doing due diligence on the infrastructure side. And that's the most important part when you invest in infrastructure, or if you in any buying and selling of homes, you have to buy well, manage well, sell well. That's the whole thing. If you can do those three, you're aces. But with infrastructure, the first one is the most important. Sometimes with private equity, the final one's the most important, and I'd say with private credit, the managing. So if anything does start to go wrong, you know about it right away, so you can step in and fix it before it becomes significant. But with infrastructure, you really, really need to do that work up front. And if you don't do it properly, then you can have difficulty. That being said, because of the very low volatility, if you, where we deal in the lower risk, that's called core and core plus. They were adopted from real estate. They don't really relate to real estate, but the institutional investors and the press and everybody, consultants picked it up, so we're kind of saddled with them. But core, there's also core plus, which is kind of just more core. They're the boring end. So A30 is a 73-kilometer 4-lane toll road south of Montreal. It can save people half an hour, 45 minutes on a trip. It's inexpensive. It's a 30-year contract to run. We have 30-year debt. It's basically a take or pay with the government. And people who take the road have a better driving experience. They're paying, but they get real value for it. Save time. It's safer. Planted a bunch of trees along the way. It all looks. Otherwise, they'd have to go through center of Montreal, and it would just be a lot of traffic. So with something like that, you can see right up front, okay, we can deliver this fantastic value. We can de-risk it with 30-year debt and take all these contracts. And at the end, we give the highway back to the government in good shape. So that's your type of asset that you really like. Or cell phone towers, where you can get 5, 10, even 15-year contracts, inflation baked in, and you become a node in someone's network for them to say, well, we don't want to rent with you. We're going to, lease from space to put our junk, our high-tech stuff. Junk that's a very technical term. It's really would cost them a lot of money to move. Plus, their system wouldn't function properly because every cell tower is in a specific site to make their network. So we don't want the high-tech stuff. We want that tower. Those are sort of the boring things that we want to have on the infrastructure side that just tick over every year and become essential to the user, but a small part of their overall spend, like water being delivered into your house. It's a very small part of what you spend in your overall life, but are you ever not going to pay the water bill? Remember, they take water out as well.
Can you change your water company? Nope. No. Whoever, not like electricity in Alberta, you can take
but
someone did say monopolies are a bad word unless you have one.
Yeah, no kidding.
Unless you're playing the game.
Well, I think the key takeaway, and it was one that Dave and I took away 10 years ago when we started getting into this private space, was how deep it is. There's just a tremendous amount of opportunity out there. It has to be obviously sourced properly to take advantage of it, but it's a market space that's much bigger or as big as any traditional financial market that everybody always sees put in front of them every day in the paper or wherever they gather their news or their financial news. So the private space is fascinating to us. It's added a lot of depth to our portfolios, a lot of diversification, and it's been awesome having you here.
My pleasure.
We really appreciate you guys taking the time to spend with us, and we appreciate your support.
It's great to be here. I should note that I have 4 Edmonton players in my playoff pool.
Oh, good. So, well, that's just smart.
We know 2 for sure. I would assume Hyman's the 3rd if you're from Toronto.
No. It's a draft. So
you don't get
a dry cycle.
Well, that's a good drafting.
Yeah, I was happy to get. He's so solid.
Oh yeah.
Especially in the playoffs.
He gets even better.
He gets nasty.
He's just one of those guys who just can turn it on. It's fantastic.
Yeah, it's fun to watch.
Too bad he's in the league, but we can talk about that next time.
Yeah, you bet. So again, thank you, James, for being here from Northleaf. We have to thank Mackenzie as well for helping bring all of this together. If you want to learn more about the products we've talked about here today, you can certainly follow us at Smokin Bulls and follow us on our socials. Get in touch with Dave and I if you have any questions. We're going to pop up a disclaimer too at the end of this. I please encourage you to read through that disclaimer so that you know what we've talked about here today may not necessarily be for you. Reach out and chat to your advisor if you want to learn more. Otherwise, thanks again very much for being here, and we'll see you all again soon.